Good afternoon, everyone, and I'd like to welcome our panel members. For those of you that don't know me on the call, Patrick Barry here, Head of Wealth at Partners Wealth Group, and thank you for your attendance today. The first of what is our seminar series around being at the top of your game, and this seminar series is part of our sponsorship of the University Blacks Football Club. We're now in our second year of sponsorship at Partners Wealth Group of the Blacks, and it's a partnership that we treat very special and hold in high regard. And I think most of us on the webinar today will have a great affinity with the Blacks, whether you have current members perhaps still involved with the club, which is, I know, has brought so much joy to many of us on the call. For us, perspective, we're really disappointed the season didn't go ahead. I know a lot of work went off in the off-season with Nick and his team to recruit some great players to the club, and we're really looking forward to see how we go this year and hopefully get promoted up to A grade. However, I think we'll put that on hold till next year, and hopefully 2022 the Blacks can be back up in A grade, so look forward to that season. Just a bit of history. Nick came and asked us at Partners Wealth Group to sponsor the club. It was an easy decision for us to make. Not only did Partners Wealth Group want to give back to the community, we also know that we have several ex-Blackers, current players working within our business. So for us, the sponsorship money was a lot less than the money we've saved in recruitment fees. So I think we've won out of that so far. So thank you, Nick, for asking the question. For those of you on the webinar that don't know who Partners Wealth Group are, it's important to know we're an advice-based business that pretty much works with clients to promote advice around strategic wealth creation, SMSF, legal, investments, lending and property. We sort of follow a set advice process that works together with other professionals such as accountants to make sure that our clients receive the best advice in relation to strategic wealth creation, structuring their investments, asset and wealth protection, the appropriate asset allocation. We're asset class agnostic. We understand the importance of all different asset classes in our clients' wealth creation strategy. And hence today we thought that a property focus would be really important given the current environment that we're seeing out there, given this COVID restrictions. One thing we're really proud of, we're recently recognised by Barron's magazine as being one of the top financial planning businesses in Australia. And our Managing Director, Matthew Cassidy's on the call, was awarded for being one of the top 10 financial planners in Australia. So that's something we really pride ourselves on, is our professionalism and our focus on great client outcomes. So I'll shortly introduce our panel members, who I do thank today for giving up their time. I know at the moment in Victoria, especially with some unprecedented with what's happening with the stage 4 restrictions, and it's impacting not only our livelihoods but also people who are running businesses, and it's quite challenging to understand exactly what the government rules are and how to adjust to those. So today our experts on the panel will cover commercial property, residential and development. There'll be opportunity for questions for those of you at the end. So if you have any questions, please type them into the chat function that we have running, and then we'll be able to ask those questions at the end to our panel members. So as I said before, we are sort of faced with an unprecedented economic challenge plus a public health perspective. The economic figures, they're changing daily and they aren't fantastic. You can see stage 4 restrictions in Victoria. The government expects the deficit this year to be just under $200 billion. Unemployment's going up to 10%. We are seeing unprecedented stimulus from the governments. We're seeing interest rates remaining low. We're also seeing quantitative easing, so we expect that to continue. So given this current economic backdrop, we thought what a great opportunity to actually speak with some people in the property industry who are experts. So I'd like to welcome our first panel member, Tim Gurner. Tim founded Gurner in 2013. I think it's a name synonymous in Victoria around luxury development, based in Melbourne, also doing developments across Victoria, New South Wales and Queensland. Before founding Gurner, Tim was the co-founder of Urban Inc., who developed over 1,300 apartments across 20 different development sites, ranging from townhouses to apartments. And we know the Gurner brand has delivered buildings that stand alongside some of the most iconic in the world. And we can see now that the Gurner brand is synonymous with luxury. So welcome, Tim, and thank you for giving up your hour today. The next speaker is Paul Kempton. Paul is Head of Institutional Sales at Knight Frank. Paul's responsible for major commercial sales within Melbourne, with a focus on institutional grade office assets, capital partnering, joint ventures and structured financial deals. He works with local and international clients to advise them on divestment and acquisition of commercial property. And Paul's also a dual premiership player with the Blacks. So welcome, Paul. Thanks for your time today. Third and final panel member is Andrew MacCann from Jellis Craig. Andrew is a director and auctioneer. He's a director of 3 inner city Jellis Craig offices. He's an experienced real estate professional and auctioneer. He has a successful career in real estate, build incredibly strong relationships and the consistent achievement of exceptional results for his clients. So welcome, Andrew, and thank you for your time today. Nick Carroll will also be assisting me in answering questions to the panel members. So Nick, thank you for your time as well. So a general question to open up to commence for the panel members is, what are you currently seeing in your sector of the real estate market? And I might start with you, Andrew. You sell homes in the inner east of Melbourne. What is occurring since March, and how has it impacted the residential property market you operate in?
Thanks, Pat. Nice to meet everyone. Thanks very much for having me on board. Well, I'd say we've obviously been a bit fortunate from a real estate perspective up until this week in that we've continued to operate and function. So the sales rate for our month in July as a group at Kellis Craig was significantly improved on the month of July a year ago. I think we sold 470 odd properties versus 360 this time a year ago. So the activity in the market has actually been a lot stronger than people would have anticipated or predicted. The reality for us is that a lot of it's not visible though, so we're not doing as many public open for inspections or auctions, but from an inquiry rate and a sale rate, the activity's been pretty good. We've seen most properties in the inner east sell a lot faster, so average days on market's down from about 30 days to near on 21, and that's probably coming in a little bit. We tend to find that the market respond very quickly to new product, and there's a clear shortage of stock. So from a supply and demand perspective, the volume is off. We're about 20% off our sales volume from a quarter basis in the June quarter, but probably not as significantly as had it been anticipated, Pat. So the reality now is that we've just been through an extremely busy period over the past 4 days of trying to move whatever stock was in market. So we've seen a lot of online auctions. Anyone that follows a real estate agent on Instagram would have seen that there's Zoom auctions and all types of sale methods that have been brought into place to try and see product transact. And the leasing space has been a pretty torrid space with a lot of rent relief requirements. I think we've probably got 25% of our portfolio under rental relief, and this new 6-week period is probably going to be the real challenge for us.
Okay. Thanks, Andrew. Have you seen any particular impact on prices within different price ranges on residential property, or is it held pretty tight? Or I know you mentioned before that you had a sale that was 300,000 above reserve. What are you seeing there?
Yeah, I think I'm fortunate to work in what I regard as the better suburbs of Melbourne. So my offices, or the offices that I operate in Richmond and but specifically are that inner eastern market, inner urban market, where there's clearly always a level of demand. The A-grade stock is still extremely well sought. So we sold a property in Malvern in a boardroom auction with 5 people participating for $300,000 above reserve at 2.3 million 2 days ago. You wouldn't have seen that type of result in March when the market was as strong as ever. The B-grade stock is certainly suffering. So if your main road or you're challenged by layout, construction type and not really attractive, the market are quite happy to see that and pass it by. So that I would make probably the fair argument that that's about 10 to 15% off on price. I think we probably saw an adjustment on price in the early parts of COVID, and then it's been genuinely stable since. And I think that stability has come from the fact that we're in a pretty low interest rate environment, and there are plenty of people that are continuing to have an appetite to move. The most segment of the market that we're seeing the activity from is the owner-occupier market.
Okay, great. Thanks for the insight, Andrew. Tim, the next question is for you. One of Australia's leading developers of luxury off-the-plan apartments and townhouses. Can you talk us through the current impact of these stage 4 restrictions, what they're having on your ability to deliver and supply the projects that you've gotten underway?
Yeah, so I think from a selling perspective, Paddy, sort of similar to Andrew, we're pretty stuck now. Obviously, for the next 6 weeks, it's interesting. Listening to Andrew, we're sort of seeing similar things. Owner-occupiers, we've actually had a really good last 10 days, which is surprising. We've done 9 deals in the last 10 days, all over $1 million off the planned sales. Investors are definitely, they've run to the hills. There's no question. There are no investors in the market pretty much anywhere. I think now we're starting to see the more sophisticated, probably more educated investors start to come back into the market to realise there actually are deals and the world isn't ending. Australia is not going to explode in 6 months' time and never come back. So our guys that have bought from us before, through you guys and others that understand the dynamics of what a supply and demand market is, do understand that there will be a rental crisis coming up. So it's an interesting market. I think there's no question. I'd say prices are off at least 0 to 10%, depending on where you are, and some of the harder hit mortgage suburbs will definitely be worse. And I think that it's all about when the stimulus stops, right? I just think the market right now is so false because there's not enough supply in the market to really get a good gauge for what the market's doing, and everyone's being propped up by government support and bank support. So I think the real hurt and real test is end of this year, start of next year, potentially now after March when JobKeeper finishes. But definitely people are holding on because JobKeeper with interest rates at, you're borrowing at 2% now is sort of keeping people afloat. So sales-wise and sentiment's obviously not great unless you are an owner-occupier who has a reason to purchase. So they're the ones that we're seeing a lot of action from. So we sold a penthouse yesterday at Atelier for 2.5 mil, no reduction in price, same price as what we would have got 8 months ago. So the owner-occupier market is good. The investors are definitely hiding, but I think they will definitely come back in groves when they realise there is a ginormous rental crisis coming, because we're already very short in supply in Melbourne, and this last 6 months there's obviously nothing has commenced and nothing has started selling. So I think the future is very bright in that sense. Stage 4 for the construction industry is a fucking disaster. To be honest, it's it came out. I'm obviously not a big fan of Dan Andrews like most people. He had since March to plan stage 4. He said yesterday that he had a really late night trying to work out what to do, which is just the most insane thing I've ever heard a premier say. To come out, it was an hour before we saw the draft release, an hour before, and major commercial sites were going to stay open. And then in the last hour before he announced it, he changed it to a 75% reduction without talking to anyone in the industry. So all the big boys, I spoke to every large builder within the next 24 hours, and I've never seen the industry in such a shake-up, so nervous, furious, people threatening to just make their entire teams redundant and just sack people on the spot, because our industry can't operate at 75% reduction or 25% capacity, because on union sites, which is Dan Andrews is all about, 25% of the labour are bullshit union officials who don't actually do anything. So if you take 25%, you've actually got no one doing anything on site. So most of the big boys push for just a 2-week full closure. They don't believe that sites can operate at a 75% reduction. So obviously you can see Dan didn't really plan much, because he's come out yesterday or late last night and loosened it a bit. So he's now said that we can use 25% of what the average per day would be across the whole life cycle of the job, which helps the sites that we have under construction because they're just starting in basements and coming up through structure. But if you're building a 60-story tower and you're on level 40, you are in real strife right now. So it's going to do real damage. I mean, the small trades that live day by day and week by week for cash flow are going to really feel the hurt this next 6 weeks, no doubt.
Thanks, Tim. Yeah, pretty a lot of uncertainty out there. No doubt that unsure government policies is adding to the anxiety of the people in the building industry. Paul, how's the commercial property market being impacted, or what are you seeing in the area that you operate in? You might just want to provide a background on what sort of transaction sizes you deal with.
Yeah, thanks, Pat. It's sort of similar sorts of themes really in the commercial market. I tend to work in that space of the commercial market, sort of typically sales in price point is sort of 100 to up to sort of $1 billion. They tend to be more sort of $200, $300 on a regular basis, but similar themes in the sense that the occupancy market's really been shot hard, and that's still playing out. Players in the market, whether it's big vendors or capital buyers, whether it be domestic or offshore buyers, are still trying to work through the impact of this extra stage 4 sort of restrictions these lockdowns is going to have. We saw a lot of opportunistic capital sort of wanting to pounce earlier in the year after the initial sort of lockdown period restrictions that were put in place, and they got quite confident that the Australian market, in particular Melbourne market, was well positioned to come back and bounce back pretty quickly. But I think this extra period of time will have certainly the capital is a lot more cautious now, and so we're certainly experiencing shortage of stock available to buy. There are some opportunistic purchases that are going on at the moment, and we've got a couple of things in due diligence where vendors sort of needed capital, not necessarily distressed, but needed capital to continue things, whether that's a development or some sort. But typically, shortage of stock, capital is certainly more cautious. But that said, there is still plenty of capital keen to place in Melbourne. It's just about what that is and at what price they can get a hold of that. So we're in this sort of period of, I suppose, expectations sort of trying to be met between buyers and vendors, and that does take a little bit of time to play out during this sort of period of time where things are changing.
But thanks, Paul. Sounds like the buyers and sellers have to reset their expectations around their pricing, I imagine. The next question is in relation to immigration. I think immigration has been a big driver of economic growth in Australia, and I think the most recent statistics are showing a significant fall in immigration from around 240,000 net to around 31,000 below the budgeted figure. So we're looking at about an 80% reduction. Also seeing the overseas students can't come back into Australia and study. A question for you, Tim. What impact do you think this will have on the property market and the broader economy?
Yeah, unfortunately, it's huge, Paddy. I mean, it's everything, isn't it? It's I think the way they've handled the student market in particular is appalling. Morrison, I think, has done an incredibly good job, apart from when he came out and said, if you can't pay your own way, go home, to all the students was a pretty crazy move. Obviously, they provide about $40 billion worth of stimulus to our economy, and they're a key factor in our rental market, in our office markets, in our universities. And when you see Xavier needing to put one of their campuses on the market and universities having to sell campuses, it's a very severe impact. And it's dire if we don't get those numbers back up. I mean, we are our economy is based on the fact that we need to grow. I mean, the Victorian economy, there's 400,000 people employed in the construction industry, and the construction industry is fueled by immigration and what business that brings. So, I think it's not going to be good next year. There's no question, but I think we will see. The one thing I do think we'll see rebound when we do get over this thing is immigration will absolutely pump. I think we'll go back to the days of, Kevin Rudd era when it was 450,000 people a year, because they're going to have to. It's the only thing they're going to have to drive the economy. And I can tell you, it's interesting, the state government, who have spent 5 years destroying our planning system and making it impossible to get planning permits, have now decided in the last 3 months that they're going to approve every single thing under the sun and try and get things going and fix the work that they haven't done. So the permits and everything will be there for the construction jobs when immigration comes back. So I think next year it's going to be brutal. I mean, unfortunately, I think this year's a write-off, 2020, and I think, unfortunately, we'll feel the economic fallout of this year next year. And then we sort of look to 2022 and think that's when the real opportunities are going to be to make a lot of money, because the immigration will come back. There will be no supply in the market of office or retail or commercial or hotels or anything under the sun, because nothing will get off the ground. So I think there are really good opportunities for the more sophisticated investors who understand looking past today. I think the guys that we see are buying now from us as investors are people that can look beyond the headlines and look beyond the white noise and grey noise and look to 2 years down the track when things are completing. What situation will we be in? And that will be that, the only option for the Australian government, state and federal, is to absolutely pump immigration, and I think that will happen.
Right. Thanks, Tim. Andrew, any comments there? Any impact in the area that you work around the residential space?
Yeah, I think I'd support, obviously, Tim's comments. Outside of, I'm probably not as parochial in terms of my comments around government today. It's having an impact for us all. I think that the piece for residential real estate, the simple part is that it's a supply and demand market. So with less activity around immigration, the last time that we had a property boom was very much driven off the back of, a Chinese-driven market, a lot of money arriving from China, a lot of investment from China. That flows through the suburbs that get hit with that money, that spreads then across Melbourne. So the one thing that none of us know is what does it look like post JobKeeper, and what does that do for the marketplace? So at the moment, we're being propped up by very low supply, and we've got low interest rates and a level of the market that have got enough cash to buy good assets. But what we don't know is how much pressure is coming post JobKeeper, whether that happens in September this year, whether that happens in March next year. So I think that the immigration piece, to come back to the market, I mean, our anticipated numbers are well down. Most of our businesses have certainly written off a lot of revenue expectation, not just for this next period of time, but looking into next year. with the anticipation that there's a lot of people that will simply sit on their hands. They'll be supported by the stimulus, they'll be supported by a low interest rate environment, but there's not going to be that level of confidence to get out there and really go hard at upgrading or upskilling because of the uncertainty that we're all seeing.
Great. Thanks, Andrew. Paul, next question for you in relation to commercial property. We only look at Partners Wealth Group, and what we had to do within 2 days was mobilise our 70-strong workforce in Melbourne here and get them home. So are you seeing any impact is that having on tenancy agreements, lease arrangements, and I guess broadly, is that how's that translating into valuations?
Yeah, I think the biggest part, sort of going back to what we sort of said before, is that the occupancy market's certainly been affected the most, which is now starting to come out on valuations. So you would have seen a lot of the major institutional owners are writing down some of their assets, recent valuations being done. In fact, we're currently in the reporting season at the moment in the financial year results, and you will see a lot of those institutions come out and report declining valuations. There could be anywhere between 5 to 10%. Probably a lot of the office stock a lot of these groups own good quality assets, and typically we haven't seen enough evidence, if only some evidence, which has only been sort of showing a sort of discount, really, if anything, maybe 2.5% to some of these really good core quality assets. Typically those assets are really well located, recently built. There's a lot of demand in the marketplace from offshore capital and local capital to buy those sorts of assets. The supply and demand sort of dynamics of those quality assets, and typically have good covenant tenants in them that have continued to be able to pay rent during these times. But the secondary assets is probably where we're seeing the greatest impact to that. Is typically poor locations, weaker covenants, and going through some hurt with through income from tenants. And as you may or may not be aware, but there are restrictions in place in terms of what landlords can do in terms of forcing tenants to, if they can't pay, in terms of sort of rental payments. So it sort of feeds back into the JobKeeper sort of proof around, having to prove you've got revenue shortage of, over 30%. And if that's the case, then landlords sort of have to work with the tenant to sort of defer or sort of waive a rent. So certainly occupancy market is having the biggest impact. It's flowing through to valuations and pricing for assets, but the better quality ones haven't seen a lot of impact on asset prices and capital. And as I said before, there are assets that have recently traded this year, and a couple indeed at the moment, that will show prices similar to pre-COVID for good quality assets, and that's just because the weight of offshore capital in the commercial market is so strong with Melbourne. One thing putting Melbourne in perspective, notwithstanding this COVID environment, is that Melbourne was very much an immature market on the global scene for a lot of these offshore larger pension funds, sovereign wealth funds, offshore players, and they are underweight Asia Pacific, underweight Australia, and underweight Melbourne. And a lot of them sort of seeing through, going back to Tim's comment, a lot of that sort of capital sees through this short-term blip for the market, albeit it might have a few headwinds and returns might drop a little, sort of placing capital for the long run that can ride through this. But it's the assets that are sort of secondary assets that are sort of currently harder hit, and we tend to think that will continue to be the case over the next sort of 12, 24 months.
Yeah, thanks, Paul. Just on that, do you think these overseas sovereign funds are prepared to accept a lower return than they have in the past, given that the capital they need to place somewhere? And with this working from home environment, do you think it'll be the new normal, or will we return to pre-COVID work environment?
Yeah, so returns have been coming down for a long time now, sort of expectations and total returns. I mean, the better sort of stuff, in some instances, sort of sub 6%. I mean, some of these big, large pension funds have got total return expectations, even in the fives now for some, really good core quality assets. And your income yield on those assets are sort of circa, mid fours. So they're not expecting, there's a little bit of capital growth there, but they just want really good audience asset. So the returns have been coming down for a lot of time, and obviously that's due to opportunistic cost and what else you can do with your money. But there's been an increase in allocations, tangible assets across the globe, whether that's infrastructure but tangible assets. So we're seeing that across the board, and property is a big part of that, and that's a big reason for that. What was your other part of your question?
With the work from home, sort of, people work from home now, and with our staff, people will work 2 days from home, 3 days when we return to normal levels. Will that, do you think, impact, I guess, the yields that we're receiving and the need for as much office space with some of these big commercial tenants?
Yeah, really relevant question. That's something that, for the last few months, all the major landlords have been trying to get their head around, what does it mean for us going forward? And it's becoming quite clear now that a lot of them are very, very confident that offers is not going anywhere. In fact, if anything, more recently, I think what it has meant that they're becoming more confident that things could turn around quicker than expected in terms of getting people back into the office. I think people are. It's more about how the office space is actually occupied. What does the fit out look like? I think the health, the well-being part, which has been coming for a while, is just going to be pushed along further as a result of this. And so how do you work around that? And the flexibility piece is obviously going to increase. So companies are probably more likely just to allow people to work from home if they can, an extra day here or there. But the need for the office space, it's a big part of productivity. It's a big part for efficiency, and it's a huge part for culture. And that's not going away in your time quickly. In fact, a lot of companies are actually thinking that this workplace density ratio that's been shrinking over time, back 10, 15 years ago, we're sort of 1 to 14. In fact, I think the average at the moment across the Melbourne market, office market's circa sort of 1 to 13, and new buildings being built are sort of density circa 1 to 10. Been trying to push below that. I think that'll be out the window. I think you'll find that that might sort of go back a bit to sort of 1 to 12. That's sort of the general consensus across the market at the moment, just in terms of you'll need that space, those outbreak spaces for tenants to have space and even sort of where they work. So that's sort of generally the consensus at the moment, but that's still playing out. And I think that's one to sort of stay close to. We're certainly staying close to, but that's generally the feeling at the moment.
I think, Paddy, too, like backing up what Paul's saying, is that people forget that, we went through the Spanish flu, we went through World War I, World War II, like cities come back. Like this has happened before. Like people are talking about this like it's an economic virus crisis we've never had before. It happens, shit happens, and we will move on and it will get back to normal. I know with my team, they're desperate to get back into the office because they all work bloody hard, and that connection with the team is everything. Like if we have work from home for 6 months, I'll lose half my team because the connection and the culture is everything. And I actually think this is, I get asked all the time, do you think office is going to disappear? I think this will only re-emphasise the importance of culture in office. I think it will go the other way.
I agree. Yeah, strongly agree.
It's a really good point, I think. I think working from home was a bit of a novelty to start with. However, once people went a few weeks, they sort of did miss their colleagues, the ability to get a coffee. So I think that it's quite interesting how it's going to bounce back. So very good. Nick, do you have a question for Andrew?
Yeah, we might just, thanks, Paddy, might just touch quickly on finance. And Andrew, recall back maybe first half of 2019, access to capital and access to credit was a big driver in the lack of buyer interest. Then obviously we've had the Hayne Royal Commission finalised, things eased up a little bit, and COVID's sort of come back on. So how are you seeing it with purchasers at the moment getting access to finance? And in the valuation space, what, if any, challenges are we seeing there with values holding up around settlements?
Yeah, good questions. I mean, it's been a pretty interesting 3 years in property, hasn't it? With really, really different impacts that we haven't seen before. I think that Banking Royal Commission, the access to credit, albeit in a low interest rate environment, really shrunk the market for volume. And we're now in a situation where from what I see, certainly credit doesn't seem to be the challenge. It's more the time, and it's more the time that the banks are giving to people. I'm working on a transaction at the moment on a good house in Armidale where the potential buyer is not going to be highly geared or leveraged, but she's got some concern that the offer in the market's got a number of COVID conditions and that it might be an offer that exists for 3 months. And then, if the property hasn't settled in that time, does she then get questioned at settlement time? The first homeowner market, we're seeing extended periods of finance conditions, so a lot of subject to finance offers rather than your traditional 7 days is now a 14-day to 21-day expectation. So the banks are slower on their response time, or certainly that's our experience. But we're not really seeing a whole lot of valuation issue at this stage, Nick. So I think that there's still an appetite to do the business. There's clearly more loops to jump through around, certainty of employment ongoing for some of the people that we're seeing that are going through that lending piece.
Yeah, no, I would agree, and I think that's, Paddy, I'm sure you see it a bit in your business, that that industry by industry look is probably the new thing to get our heads around, and there might have been standard criteria, but there's really going to be that industry overlay that the banks will be looking at servicing capacity and risk around that servicing over the next sort of 6-month period in particular. So I'll throw back to you, mate.
Thanks, Dick. Tim, question for you. We know you've recently settled your latest developments down at most residents in Melbourne, and also the Spanish club in Fitzroy. I think the other part residents were settling in March when COVID first hit. How did the settlements go, and what sort of yields are you seeing from this blue chip property?
Yeah, it's interesting. So Albert Place, we settled 3 days after the lockdown was called, as you know, Paddy, because you had a few people there. It couldn't be worse time. I settled that in Hawkesburn the same week, and we were very, very nervous, as you can imagine. I expected it to be pretty bad. I expected the valuers to be pretty conservative because they didn't know what was happening. I expected the banks to be conservative, and it was an absolute shock. We had the best settlement rate we've actually ever had, which I thought maybe we were just fortunate that most of the bells had been done pre-lockdown, but actually it was fine. We did have a couple of valuers that did hit the property harder because of COVID, which was unfortunate, but we just went to alternate valuers, and then they were all fine in the end. And we had 2 out of 142 not settled there, Paddy, and it was quite incredible. They settled very, very quickly and probably quicker than they typically would. So the settlements were great. The rentals there, because it is sort of tied into the CBD market, has been harder, definitely harder, because there's just a lot of stock got dumped into the CBD, and it obviously has put pressure on rents without doubt. And then you go to Spanish Club, which we just settled a month ago, and we settled all of them in 1 day. So it was, and we've never done that before, so it was as good a settlement as we've ever had. And that project there in Fitzroy, because it is out of the CBD rental market, we had 500 people there at the first inspection, and we had 10 applications per apartment for rental, and they leased all in 30 minutes. So it was a ridiculous result at Spanish Club, something that we wouldn't have expected in a boom market. That project, I think, is a little bit unique, though. It's always had a very big following, that project, and the Fitzroy Collingwood market is kind of the hottest, I would say, the hottest resi market, lowest vacancy of 0.8%. It's pretty hard to beat from an investment perspective. So, Spanish Club they all went really well. Hawkesburn Place, 21 apartments at average 5.5 mil. We did that 10 days after the lockdown, and we settled all of them 3 days before the due date. So anyone who has got a lifestyle reason, it's kind of like what Andrew was saying earlier, I think anyone who's buying for a lifestyle reason is in a bit of a hurry, to be honest. They're actually in a hurry to move in, they're in a hurry to settle and get in, and that's been, it's been really good, surprisingly, because you would expect it to be a lot worse. I think the banks are definitely nervous, though. I think the banks, if you're in the hospitality sector, obviously it's going to be very, very difficult to get funding if you're in travel or leisure. But fortunately for my buyers, and definitely Paul's and probably Andrew's as well, there aren't too many buyers in the hospo space. So most of our buyers are, well-educated professionals who have got steady streams of income. So far, so good.
Thanks, Tim. Paul, question for you, and it sounds like you're saying there's plenty of money offshore to buy some of these quality assets. Have you seen any opportunities in the commercial space of recent, given the current restrictions, or is it pretty much valuations are holding strong?
Yeah, I think there's still a bit to play out in this space. I think, this extra period of time will sort of mean there's probably going to be more distress flowed through to some sort of, owner-occupied sort of stock. A good example of that is the Flight Centre building 436 St Kilda Road, a company that occupied a property, owning property, isn't their main game. So, they obviously hit hard early on because of the travel restrictions that were put in place, and they needed cash. So they quickly traded that, and that was really seen as a probably distressed, first one sort of distressed sale that came to market. It actually achieved a pretty good outcome in the end. So the price that they achieved, you wouldn't say it was necessarily a distressed sale, but the motivations of the vendor was distressed like nature. So, that's a good example. I think we'll see more of that over the coming 12 to 18 months. So that's one we're keeping very close to and monitoring, and there will be some opportunities in that space to come. And that's typically sort of more that secondary market that I was talking about before. And then what we are seeing at the moment is one at the moment we're dealing with that's sort of a very good core quality asset that it sits in a diversified fund for a major institution where they've owned a lot of retail assets, and just given retail is performing very well, the investors in that fund, and you're talking about some of these investors are superannuation funds or other institutional style groups that have sort of wanting some redemptions out of that fund, and so that fund, that larger institution group, is needing to make a call to sell a couple of their good quality assets to bring in cash to feed those redemptions requests. And so that's where there's other little opportunities that come up this time of cycles, and they're sort of the opportunities that you wouldn't otherwise get. Good quality asset wouldn't otherwise be on the market, but they're the sorts of opportunities that can come along as well. So yeah, we are seeing a few opportunities here and there. And the other part of our market is larger style commercial development sites. There's a few of we've had offshore buyers, whether it be Chinese or Malaysian groups, that have purchased a lot of larger style development sites over the last few years, and they have sort of unable to get the capital required to do what they had visioned, and in those instances they're actually prepared to take a bit more of a discount than they would have otherwise got because of COVID. So there are a few areas, and I think particularly the distressed style assets and the owner-occupied assets that isn't main game. You'll see, that goes to universities as well. Like this RMIT University, you've got an asset on the market in the middle of the Melbourne CBD at the moment. Those sorts of assets that are owned by groups that aren't typical players in that space will sell some assets over the next period of time.
Yeah, thanks, Paul. It's interesting. We've recently sourced the high fund investment opportunity for our clients through Newmar. They purchased the David Jones building in Burke Street, the iconic David Jones building, and that was pre-COVID. It was being marketed for $150 to $160 million, and when COVID hit, a lot of the offshore buyers sort of withdrew, and they purchased that for $121 million. So $30 to $40 million discount to what was being asked 3 months earlier, which is great for them. So that's provided the opportunity for for clients to go in and get a pretty good return off the back of I guess a COVID opportunity that's surfaced. So that's quite an interesting space to watch, I think.
Yeah.
Right. A question for you, Andrew, in relation to businesses have had to pivot to actually and innovate to survive and still be able to provide their services. What's changed for you in the way you engage with your clients and how you do usual transactions within the residential real estate space?
Yeah, it's been interesting, Pat. I mean, I think that one of the good things that's come out of COVID is that it's forced our industry, which is, I wouldn't say that it's the sale methods are archaic, but I've been in the industry for 22 years, and I've been running a 4-week auction campaign really unchanged for that period of existence. We used to go out and see vendors in their homes, doing that via Zoom. What's really changed is the ability to speed up the transaction. So I think rather than waiting for a 4-week exercise, is that we've seen both the agents, the vendors, and the buyers themselves have been much more prepared to act quickly. less of that print media advertising, a whole lot more efficiency online. We're seeing property released to the market with virtual inspections now available for rent, which is something that, again, you probably deal with a more pre-qualified potential tenant who's done their inspection, made their application, and then literally walks through and takes the keys on the premise that they're happy with what they're seeing. So those things have probably been the main game. The work from home piece hasn't been the challenge that we expected it to be, but I'd probably agree and concur with the comments from Tim and Paul about the cultural part. I think one thing that as an industry we miss is the energy, and certainly your lower tier of operator not being exposed to your more experienced. That learning ability in business, I think, is really important. So I can't see that change of office structure is going to be significant. But the virtual realities of challenging the style of selling, we've moved a lot of auctions into expressions of interest for the fact that we couldn't conduct and we can't conduct auctions at the moment. And it's been well accepted. The market accepted it very quickly, and the results have been strong. So I think that when you get put into uncomfortable situations because you're just not used to that level of change and adjustment, challenge of thinking in the past, it's been quite a good learning for the industry.
It's been interesting, Andrew, just touching on that. And I think you talk about you don't always accept what you read in the press. If you read the clearance stats or the auction stats, you'd think no one was selling property. But as you said earlier, we've actually sold more than what we did this time last year. So it's incredible the way it's pivoted. I just wanted to touch a little bit on the investor and rental market. And Tim made some pertinent comments on investors before. I think certainly one of the things we're seeing at Jellis Craig is that element of lifestyle come into the equation as much as investment at the moment. We're fortunate enough to have a couple of offices in the country, in Ballarat and up in the Macedon Wood End sort of area, and they've just come off record months, and both from an owner-occupier and an investment sense where people are clearly moving up there for lifestyle reasons, but savvy investors are looking at it and seeing I can get a 4 or 5% gross yield up there, and there's likely to be a further migration up there. So clearly there's going to be some short-term impacts on the rental market, we know that, but how do you sort of see that investment market playing out in the longer term?
Yeah, well, I think that Tim's data is probably a little bit more relevant to the apartment space and what that supply looks like. So I wouldn't want to contradict anything that he says. I think you probably have a stronger view on that reality. The mums and dad investors at the moment are probably the people that are not part of our market. And when they return, I would expect they come back when they see more confidence around the tenancy pool. So at the moment, we're probably carrying 25% more rental property than we would traditionally at this time of the year. And we've got a fair part of that mum and dad investment portfolio that's under pressure because their tenant can't afford to pay full rent. Now, we probably didn't suffer JobKeeper's helping people to pay rent. So we're going to deal with a period of transition there. And then what that looks like at a lot of end of lease is probably the big question. But I think what we're probably more seeing is that with the flexibility of work and travel, I think, we sold 70 properties out of our Ballarat office for the month of July. And if you talk to the guys that own that business, with which I wish I was an investor at the moment, they tell you that that's all Melbourne money, people that are making decisions as owner-occupiers to move into that market and leave city lifestyle behind. So I think areas like Mount Eliza that have got that beach lifestyle, yet still large communities with schooling will have growth for the owner-occupiers. And I think that's probably the marketplace that's probably going to be more active, is moving homes for lifestyle than necessarily people diving back in as investors. I think until we can see the rent market stabilise, I think it's going to be pretty tough for us to see that investor profile come back. Again, I'd probably try to Tim to see whether that's something that he would agree with, given he's a developer of apartments of an occupier profile.
Yeah, 100% agree with Andrew. The mum and dad investors have definitely been the ones that have disappeared, and mum and dad investors are sentiment driven and they're newspaper driven. So it's very much, if there's a property boom coming, they're all in, and when there's a property boom going, they're all out. And I guess our sophisticated investors and the Warren Buffetts of the world, when they want to buy when no one else is buying and sell when everyone's buying. And mum and dad investors always have the opposite opinion to that. So our more sophisticated investors are still buying, but the mum and dads who probably aren't as sophisticated definitely have stopped. And Andrew's 100% right. It's all about, rental, and you can't in the property industry pretend the rental market is in good shape, because it's not. I mean, we had 40,000 students go home. You had 60,000 Airbnb apartments come out of the short-term market, go onto the long-term market. So there was a massive dump of apartments in the CBD. And although it's not where Andrew and I are in the CBD, it does spread, because if those rents drop by 20%, everything's kind of got to follow in, unfortunately. And that's kind of what's happened. And I think the long-term story for Melbourne, though, is exceptionally good, like we were talking about before. I mean, we will still come out of this as one of, the world's most livable cities. We've got huge population growth, which will definitely continue after next year. And supply, it's all about supply and demand at the end of the day. And I can tell you, as a developer right now, you cannot supply apartments to the market. It is impossible. So, it is a good time over the next, 3, 9, 12 months to get into investment property, I believe, so that you are, when those buildings are completing in 2 years' time, 3 years' time, we will definitely have a rental shortage and a proper rental crisis, because you can't just turn the tap on supply overnight. Let's say that the mum and dads do come back in 12, 18 months' time, it will take another 2 to 3 years for those apartments to be completed. So there will be a period of, boom, because there will be an undersupply. I'm not saying it's next year, and I don't think it is next year. I think it's probably the year after and the year after that. But when it comes back, it will come back hard, because governments are going to have to keep on pumping money in. And, Australia's got one source of income, which is going to be immigration, and that's going to be the only thing they're going to be able to really toggle with. And that's what they'll push hard, I believe.
Thanks, Tim. And while I've got you there, Tim, I might get you to speak a little about St. Moritz beachfront residence that you sold out in St Kilda on the side of the old Nova Hotel, which no doubt will become an iconic building in Melbourne. There's been considerable media attention around that development. We had directors buy into some of our clients. Tell us about this development, why you think it was so successful in selling out so quickly. And I think we set some records in relation to some of the penthouse there as well. So tell us about that project and why it's been so successful.
Yeah, look, it was a funny one. It was a really interesting time. We launched it at a time where I had all the old boys who support me in the industry told me not to launch it, because it was just after Turnbull got rolled, and we're in that weird section of when the election was coming in March, and virtually business stopped, as everyone will remember. And I was very nervous doing it, and we the site obviously went to the market. It was CBRE that was selling it, and there was a lot of competition for it. It was, I would say, one of Melbourne's best sites, if not the best. And I actually wasn't even looking at it. The owner came to me and said, "Would you joint venture it with me? Because I think you could deliver it." And so we did it. And I had a vision to go to a pretty silly level. I mean, this is it's been marketed as, we haven't really shown people what it is yet. This will be one of the top buildings in the world. That's what we targeted to be. It's a very unique spot because it's obviously on the waterfront, but it's also on the top of the hill. So you've got a lot of the apartments look towards the city, which is arguably as good, if not better, than the water view. So we didn't have a bad side of the building, which is a very unique thing. And we had a very large-scale project. So when you've got $500 million of revenue, it allows you to do some pretty crazy stuff. So we went pretty full-on with the service and amenity. It's we've got about 6,000 square metres of amenity through it, from cryotherapy to golf simulators to gyms to everything you could imagine. And trying to hit on what exactly that downsizer wants. They want that social aspect. They want the lifestyle. They want to, they want to feel great, look younger, and have good fun doing it. And that's kind of what we targeted. And we did it differently. We introduced a few local agents in just to have a look at the display and said, the times are a bit funny. I don't know how it's going to go. Why don't you bring a couple of people through and see how we go? And the first day we had about 4 people. The next day about 8, and then we had 40 every single day for 3 weeks in a row. And we sold 350 million from the 1st of December till the 21st of December, and came back in Feb and then did the balance of it in another 3 weeks. So it was just an incredible project. It was weird. It was just one of those ones that just everything sort of fell into place. There was massive momentum. As anyone knows in business, you need that momentum. People need to feel like they're going to miss out. And that was very much what was happening. I mean, we had situations, and I think one of the directors of your business was in the room, and we had a lady crying because she missed out on an apartment. And as a developer in a display suite, to have someone cry because they missed out is probably the best thing that could ever happen. And it just sort of rolled from there. And we started construction with 6 left, and We sold 4 in the last month, so we got 2 apartments left, and that's it out of 132. So just a bit of a dream project, to be honest. I mean, it sounds all great in that. Obviously, it was ridiculously brutal work. I mean, I didn't leave the display suite for pretty much that whole 6 weeks. I was there, 7 in the morning till 11 at night, and did all the selling myself because it's kind of what you need to with that product. But just an amazing project. And the great thing about it is it will be incredibly, it will be better than what people's expectations are at the end. It's a very, very special precinct.
Right. Thanks, Tim. A question for the panel. We've seen unprecedented measures by the government in relation to JobKeeper, injecting money into the economy to keep industries alive and support families. Now's most will be a time where we can look at some policy changes in relation to certain areas. What certain areas would you speak to the government about changing in relation to any policy they have that you think could help reform the markets you operated in, but also provide more prosperity going forward? I might start with you, Andrew.
Well, I don't know if it's a policy reform we require at the moment. I wouldn't mind if just get confirmation that we could have JobKeeper for another 6 months, and then that'll see us in a position to continue to do our part and employ all of our people. I think that what we've learned through COVID has been that there's probably been a few things tested around residential tenancies that might need to have a bit of a look at. The way that we buy and sell property, I don't think in the state of Victoria there's probably a whole lot that you would do around the process of it. I think if we're looking to try and create stimulus, clearly we're going to need a segment of the marketplace to respond. So whether that's some stamp duty exemptions, that's obviously one of the bigger plays that the government have to lever. I would think that's the obvious. Now, whether that's continuing to go back to the first homeowner market, I know that the early stimulus tends to head in that developer space for the green wedge and the cheap new builds. But whether we see some of that start to impact back into the mid segment of the market, I would have thought that will certainly help to pump some activity back in. That'd probably be where I'd head.
Yeah, thanks, Andrew. Tim, any comments around reforms? Like, stamp duty.
Yeah,
obvious one that's discussed.
I think there'll be. I'd certainly be in my bonnet. I think that there will be reform in our sector for sure, without doubt. I think stamp duty is the obvious one. I think, even if they've got to time it right too, though. It's interesting because if they brought it in today and just brought the exemption back, I don't actually think it would have any effect. They need to bring it back when sentiment is feeling a little bit better, and I think that timing is really important. Foreign investment is something that they have to get back to a normal international competitive level. We sort of, we had this golden goose of the Chinese investors who provided us all jobs and incomes and money, and we just told them to go away. And they're not silly, the Chinese. They just go and place their money in Canada or New York or London or wherever else. They're not going to get charged 15, 16% because they're Chinese. So I think the international charges is something they have to focus on. The stamp duty is obviously a key focus as well. I think the other one, unfortunately or fortunately, the build-to-rent sector will get a big stimulus, I believe, from federal and state. New South Wales came out last week and rezoned industrial land for build-to-rent and also did a 50% reduction in land tax. I think that will have an effect and become a big industry, which Kempo will be happy with because I think that will be a big part of the next buying of sites cycle.
Thanks, Tim. Paul, any comments around that? Any reforms you'd like to see come through?
I was actually going to comment on the land tax on build to rent. I'd like to definitely see. I'm a big believer in the build to rent segment of the market and how it's coming. I think it's definitely, as Tim said, it's definitely going to be a big area, a new growing sector for institutional capital, global institutional capital. It works very well in America, UK, and it will happen in Australia. It's just a matter of time. I think there's a need for it now, and I think it's only a matter of time, from what I understand, that the state government of Victoria are going to give exemption around help with the land tax bill for build to rent players. We've seen that in New South Wales, as Tim said. I think it's only a matter of time before Victoria changes their policy on that. My understanding is that they were pretty keen to do it before New South Wales. They were trying to beat each other, but New South Wales got through their policy earlier. Look, the couple of things that have changed during these times, which has been a positive, would be, the speed. Tim mentioned it earlier, but the speed in which the government sort of getting through planning permits, which is good. So that's a tick. Foreign Investment Review Board approvals. Obviously, there's a large portion of buyers in our space that you need, obviously, further approval before settlement can take place. That's been sped along relatively quickly recently, although that's taking a bit longer to take shape to get that ticked off in some instances. So I'd like to see that probably be pushed along. That'll again help with activity. The only other thing would probably be land tax on foreign owners. Tim mentioned before some policies. Obviously, these guys can just go somewhere else around the globe, and that's certainly the case with the capital we deal with. Some are agnostic sometimes about where they place their capital, and if you throw in another sort of cost, then they'll just go somewhere else in the globe. So it would be good to see land tax on foreign owners sort of abolished, but I don't think that's going to happen anytime soon. But because at the moment, if you're a foreign owner, you get charged a hell of a lot more on your land tax than if you're a domestic owner. So straight from day dot, effectively they're having to pay more to buy an asset.
Thanks, Paul. Now, I might have one or two questions from the floor if anyone wants to ask a question before we wrap up. So is there any questions in particular that anyone wants to ask for our panel members? No?
I know there was one there. We were going to ask Paddy, Andrew, I'll throw to you maybe if you just want to finalise. I know you've got to rush off to your end of financial year party, which you might want to tell everyone what you're doing. But you talked a little bit about opportunity and potentially the smart money, as Tim and yourself have said, is maybe sitting back a little bit and waiting and see. But where do you think that smart money will be looking from an investment perspective going forward? And maybe for those people who are thinking about whether it's time to upgrade or trade up, what would you be suggesting to them over the next sort of 6-month period?
Yeah, well, some good questions there. We've got our. I'll touch on the first place, which is the social activity. I'm as dressed up today as I have been for the last 9 weeks. I think Tim Gurner and I are both wearing a jacket for the first time in a long time. Part of it is for the crowd here today. I didn't want to let you down, Nick. Secondly, we've got our end of financial year Zoom party about to happen, our yearly awards, and generally trying to get some fun into our culture, which I think is a really important thing to keep happening in business. As far as the smart money, in terms of the upsizes, I genuinely always believe that when you've got a marketplace with low interest rates and there's a bit of hesitance, that it's a good time to capitalise if you own a home in the better suburbs of Melbourne. So you talked about somewhere between Richmond through Albert Park, South Yarra, inner urban. At the moment, between 1 and 2 million is exceptionally strong, and there's really strong demand. Like we're seeing offers 4 or 5 deep come through on homes. Any of the virtual auctions that we're running are selling for a good 10 to 15% above. Yet the product at 2.5 to 5 million is probably a little bit more cautious, and some of those people are people that just actually sit back and wait and watch a little bit. So there's not as much competition there. So I think if you've got some certainty of employment income, it's a good market to be trading on. As to where I think the money moves, I am a believer that I think that through this experience that people are going to chase lifestyle a little bit. I know that we're seeing a number of clients that are moving towards, Flinders is an extremely hot market for the 40-somethings that think that they can educate their children from down there and come to Melbourne 3 or 4 days a week. And I think, the level back from that, when you look at what you might spend in a Mornington or a Mount Eliza, Mount Martha for 1.5 million goes a hell of a long way in comparison to what that might buy you around San Antonio or some of those other Bayside suburbs. So that's where I would predict the trends. But I still think that, the investment piece, if you've got capital and you can afford to write it out a little bit, buying an investment apartment at the moment, it's probably 10% off its value. That's probably the market that's got the most flex in it. And if you can afford to cash flow it out on either a reduced rent for a 12-month period, that's where I would expect the most upside.
I think, Nick, the one thing that we haven't talked about today as well, which Andrew will be saying as well, is rents might have come back 5-10%, but interest rates have dropped 30 or 40. So, you know, someone who bought 2 years ago expecting a 4.5% yield, they might have been paying 4% interest. They may now get 4.25, but they may be paying 2.25 in interest. So, you know, our investors who bought 2 years ago, although rents have come back a bit, they're actually well ahead. So, and it's no different. I mean, in Paul's world, when interest rates drop, yields compress. I mean, there's no reason why resi, in theory, shouldn't have a bit of an adjustment. I mean, interest rates have significantly dropped, so rents probably should have come back a bit anyway, naturally.
Yeah.
All right. Thank you for the time. We might finish up now unless there are other questions. I'll have the final opportunity.
I was just wondering if Nick's haircut was why, you know, just a wife running her hands through that short hair. Nick, is that helping get through the isolation?
She's pretty happy with it, I've got to say. I'm not sure if you were on earlier, Gary, but I'll repeat it. You know, I've learnt a lot from my colleague, Mr. McCann, on there, and he gets by with a very, very sharp haircut. So I thought I'd sort of move to be as close to him as I could get away with, and gone with my ISO cut.
Well, good to see the wife's enjoying it.
Okay.
Not sure if that's factually correct.
Okay, thanks, Gary. I'd just like to thank Paul, Andrew, and Tim for your time today. I think it's been great insights into the property market that you operate in. What we've heard about it's unprecedented times for us. There's an optimism there around the strength of the property market. We may go through a few peaks and troughs per in the next couple of years. There'll be opportunities there. So thank you for your insights. It's been really valuable. This is the first of our series seminar, Top of the Game for the University Blacks. We look forward to bringing more of these to the attendees. And if anyone today has any questions, I want to reach out, have any advice, question, whether it's property, investments, etc., please reach out to the team of partners. We'll be more than happy to speak to you. So thank you again for everyone attending. Thank you for the panel members, and everyone keep well, and look forward to when we can catch up and socialise, not through video conferencing. So thank you. Cheers.
Thanks, Paddy.
Thanks.
Thanks, everyone.
Thanks. Cheers.